Welcome to another infographic instant with Brian Michael. In this episode, we'll be looking at the extent to which good corporate governance practices translate into higher returns for portfolio investors in Hong Kong stocks. A word about the paper this infographic comes from. The paper assesses the extent to which Hong Kong's corporate governance practices correlate or harmonize with those practices in other countries such as the US and the UK. The overall study looks at ways of changing Hong Kong's corporate governance regulations in order to attract international portfolio capital into Hong Kong, making it a more vibrant international financial center. Turning our attention now to the infographic, we see three groups of companies which have been analyzed by Chung et al. You can see their paper for more information about the time period they cover, the types of companies they look at, and the methods that they use. But in general, their study attempts to assess the extent to which abnormal market returns, that is, the returns that stocks earn over a period above or below the market, correlate with differences in corporate governance scores, excluding or controlling for other factors. Therefore, the authors specifically try to isolate the effect of corporate governance on stock market risks and returns. Now, turning our attention to the first group of companies, those with high corporate governance scores, we see that their abnormal returns come in at about 8% over the period, and we also see that the risk that investors took in investing in those companies with these high scores was relatively low, a little less than 2%. In contrast, medium corporate governance scoring companies' returns, abnormal returns, came in at about 2%. Therefore, we see a significant difference in the return, and indeed, we see slightly higher risk taken on by investors who put their money in these medium corporate governance companies rather than the high corporate governance scoring companies. Finally, turning our attention to the low corporate governance scoring companies, we see that their returns were negative over the period at about roughly 4%. So what that means is that investors would have earned a significant corporate governance premium if they put money into these high corporate governance score companies as opposed to those with low corporate governance. And indeed, they probably would have taken on less risk over the period. This suggests that better corporate governance practices increase the risk-adjusted rates of return to certain types of securities. And of course, investors sitting abroad in New York or London would see these data and they would understand that they should put money into companies with better corporate governance practices. That suggests naturally that by increasing corporate governance practices and regulations governing those practices, we can attract more capital into Hong Kong. This has been another infographic instant with Brian Michael.